Can you imagine? In a nation hailed as the world's largest automotive market, car manufacturers are selling more vehicles than ever, yet their losses are mounting at an alarming rate. In the first half of 2025, 7 Chinese automakers collectively reported losses of 18 billion yuan. To put that into perspective, 18 billion yuan could purchase an iconic office building in a 3rd or 4th tier city, yet these companies burned through it in just 6 months. This isn't the isolated failure of a few firms, it's a systemic collapse across the industry. Profit margins have plummeted to historic lows, and the more vehicles companies sell, the deeper their losses grow. Even NIO, once celebrated as a leader in the new energy sector, is now mired in financial distress. On September 2nd, NIO released its second quarter financial report for 2025, revealing a net loss of 4.99 billion yuan. Yes, a net loss. For the first half of the year, their cumulative losses reached 11.75 billion yuan. This translates to a staggering daily loss of over 64 million yuan. Put simply, even if NIO were selling cars every minute, their finances would still be hemorrhaging. CEO William Li stated in the earnings report that achieving profitability in the fourth quarter is their goal, but he acknowledged it as a formidable challenge. In truth, it's closer to an impossible mission. Last year, NIO recorded a loss of 22.4 billion yuan, and the trend continues unabated. The capital markets have grown weary, with NIO's U.S. stock price tumbling 17% in pre-market trading after the report. Investors are clearly signaling a loss of confidence. While NIO's struggles reflect the harsh realities of technological competition, Zotye's story is almost surreal in its bleakness. In 2024, Zotye Auto sold just 14 vehicles, not 14 million or 14,000 but 14. That's fewer than a small-town used car lot might sell in a month. Worse still, Zotye's Chongqing branch saw its T300 assembly line dismantled and auctioned off by court order. After 2 failed auctions, the company has lost all capacity to resume production, effectively losing its operational core. In 2024, Zotye's revenue was 558 million yuan, down 23.96% from the previous year, with a net loss of 1 billion yuan, a 6.82% increase from the prior year's loss. Not only is Zotye failing to sell, but it's also bleeding money, a textbook case of a failing enterprise. In less than a decade, this once promising automaker has crumbled into obscurity. According to Yikai, the first half of 2025 was a financial disaster for China's 16 listed passenger vehicle companies. 6 of them, GAC Group, BIC Blue Valley, XPeng, JAC, Zotye, and Haima, collectively lost nearly 7 billion yuan. Most alarming are the year-over-year net profit declines for GAC and JAC, which plummeted 357% and 267% respectively. This isn't a mere downturn. It's a catastrophic drop. Meanwhile, leading firms like Changan, SAIC, Great Wall, and Geely have seen their profitability erode significantly. These companies, once symbols of China's manufacturing prowess, now face balance sheets awash in red. On the surface, the market appears vibrant. From January to July 2025, retail sales of passenger vehicles nationwide reached 12.728 million units, up 10.1% year-over-year. July alone saw 1.826 million units sold, a 6.3% increase. Wholesale and production figures were even stronger, setting new records. Yet, profits tell a different story. In July, the industry's total profit was just 29.3 billion yuan, down 17% from last year, with a profit margin of only 3.5%, a new low. For the first 7 months of 2025, industry profits totaled 273.7 billion yuan, up a mere 0.9% from the previous year, with a profit margin of 4.6% lower than the prior year. The industry is caught in a scale illusion, impressive numbers masking dwindling finances. SAIC Group, the industry giant, reported 627.59 billion yuan in revenue for 2024, but its net profit attributable to shareholders was a mere 1.666 billion yuan, down 88% from the previous year. After non-recurring items, it recorded a net loss of 5.409 billion yuan. BIC Blue Valley's ArcFox brand appeared promising, with sales exceeding 10,000 units for 5 consecutive months in 2024, reaching 12,000 in December. yet its full-year net loss widened to 6.948 billion yuan, with a gross margin of minus 14.94%. In plain terms, the more cars sold, the greater the losses. This is the stark reality of Chinese automakers. Apparent sales triumphs conceal a loss abyss. Why are Chinese automakers in such dire straits? The answer is simple: relentless competition. In 2023, Citroen's C6 sparked a price war by cutting prices to 90,000 yuan. In 2024, BYD escalated the battle, pricing the Qin Plus below 80,000 yuan, cheaper than comparable gas-powered vehicles. Other new energy brands followed, throwing the market into chaos. Wang Xia, president of the China Council for the Promotion of International Trade's Automotive Committee, stated that unrestrained price wars and reckless technological pursuits are eroding corporate profits. Consumers may benefit temporarily, but in the long term, they face declining quality, reduced after-sales service, and faltering support. In contrast, Germany's Porsche, under the Volkswagen Group, reported 40.08 billion euros in revenue for 2024, with an operating profit of 5.64 billion euros. Their per-vehicle profit remains remarkable, proving that premium branding and differentiation are the path forward. Regrettably, most Chinese automakers remain trapped in a destructive cycle of price slashing. Sales reach new heights, but profits hit historic lows. While new energy vehicles appear to thrive, capital markets are witnessing a mass exodus. The Chinese auto industry is caught in a prosperity illusion, masking a brutal cycle of decline. On the surface, delivery figures for NIO, Xpeng, Li Auto, and ArcFox are rising, suggesting the continued rise of China's new energy vehicles. But the capital markets see through the facade. After NIO's September 2, 2025, earnings release, its U.S. stock price fell 17% in pre-market trading, a recurring pattern with each quarterly report as markets signal with plummeting stock prices that this prosperity is illusory. Wall Street's perspective is clear: sales growth does not equate to profit growth. Worse still, under the combined pressures of price wars, diminishing subsidies, and rising supply chain costs, Chinese automakers' profitability may be locked in an irreversible downward spiral. Some argue that price wars benefit consumers, but in reality, they're a slow poison dragging the industry into ruin. BYD's decision to price the Qin Plus below 80,000 yuan ignited a price-slashing war in the new energy sector, giving it a short-term sales advantage, but trapping all competitors in the same pitfall. In 2024, the average gross margin in China's auto market fell from 12% in 2019 to under 5%. In the first half of 2025, it was a mere 4.6%. The industry earns scant thousands of yuan per vehicle, yet must bear enormous costs for R&D, distribution, after-sales, and marketing. Many firms survive only through financing, and when capital dries up, their losses are laid bare. This isn't prosperity, it's a reckless, trade price for volume frenzy. These losses aren't just numbers, they represent a profound societal tragedy. In 2024, Zotye's complete production halt led to thousands of job losses, impacting supply chain factories, dealers, and logistics firms. Giants like SAIC, GAC, and Chang'an, though still standing, are grappling with profit declines, production cuts, and layoffs. Workers face shrinking wages, increased overtime, and in many cases, accept zero bonuses to keep their jobs. According to the Ministry of Human Resources, China's auto industry directly employs over 5 million people and supports more than 20 million jobs in related sectors. Persistent losses could trigger a massive social upheaval. Job losses mean countless families lose their livelihoods. Meanwhile, Japan's Toyota reported a net profit of 72.7 billion yuan in the first half of 2025, 1.9 times the total profits of China's 16 listed automakers. Germany's Porsche earns more per vehicle than some Chinese mid-sized automakers make in a year. Why the disparity? The core issue is technology. While Chinese automakers excel in batteries, motors, and electronics, they remain constrained in critical areas like chips, automotive-grade operating systems, engines, and transmissions. They compete on price but struggle to build sustainable profit barriers. Looking ahead, Chinese automakers face three existential threats. First, subsidy reductions. Local governments are financially strained, and new energy vehicle subsidies are phasing out, intensifying price wars. Second, rising supply chain costs. Fluctuating raw material prices and increasing battery costs are eroding already slim profits. Third, export barriers. Chinese automakers aim to clear inventory through exports, but Europe and the US are imposing anti-dumping measures. The EU has introduced tariffs, and the US has effectively blocked Chinese electric vehicles, making exports a challenging path. Under these pressures, sell more, lose more will define the industry. Since 2023, China's auto market has become a battlefield of price wars. Manufacturers are spending heavily on advertising, slashing prices and chasing market share, while dealers are forced to accept minimal or no profits. Factories produce relentlessly to maintain impressive sales figures, but these sales generate debt, not profit. The China Association of Automobile Manufacturers reports the industry's debt-to-asset ratio at 63%, with some firms exceeding 80%. A single funding disruption could lead to collapse. As an industry insider remarked, China's auto industry isn't competing, it's destroying itself. Some claim cheaper cars benefit consumers, but the reality is far grimmer. Price wars squeeze profits, forcing cuts in R&D, leading to corner cutting in production, and reducing after-sales service. Quality assurances weaken, and some companies selling at a loss simply disappear. Consumers may gain short-term savings but face long-term risks in safety and support. China's auto market is a giant bubble, vibrant in sales, but hollow in profits. In July 2025, retail sales grew 6.3%, but profits fell 17%. It's as if a factory runs at full capacity, only to lose more with every product made. Worse, this bubble continues to inflate. Automakers can't stop for fear of losing market share, and investors hesitate to exit, dreading worthless projects. Everyone is holding on, bracing for the moment the bubble bursts. Thanks for watching and joining us on this journey to unveil China's many layers. If you found this video insightful, please give it a thumbs up, share it with others, and hit that subscribe button to stay updated. See you in the next video.